The SCHD, or the Schwab US Dividend Equity ETF, is one of the most popular dividend growth ETFs for good reason. This ETF, for one, has offered some massive appreciation as far as ETF price over the past 12 or so years. Also, the ETF tracks a high quality index of around 100 different stocks that all pay dividends and have historically paid more and more in dividends over time, which gives SCHD a nice decent starting dividend yield of around 3.53%, but maybe more importantly, a massive amount of dividend growth over time. But in this video, we are going to go over a specific strategy on how SCHD investors could supercharge their dividend and get paid an extra dividend altogether, so to speak, by utilizing the strategy we're going to go over in this video. Now make sure to stick around, drop a like down below, and subscribe because you are not going to want to miss a thing. So just to back up for a second and going through some math, SCHD currently pays around a 3.53% trailing 12-month dividend yield, or around $2.60 per year. So if we were, for example, to purchase 100 shares of SCHD and get paid around $2.60 on a yearly basis, we could in theory earn around $260 per year in dividends. Now, the method that we're going to be talking about in this specific video on how investors that might hold on to quite a bit of shares of SCHD could supercharge their dividends and get paid more and more cash for doing so. We're going to be talking about selling covered calls on SCHD shares, and I'm going to walk you through how to do it step by step. So first of all, let's go over some of the basics. What is a call option? A call option is an option contract giving the owner the right but not the obligation to buy a specified amount of an underlying security at a specified price within a specified time frame. The specified price is known as the strike price, and the time frame is known as the expiration date. Now, when you buy a call option, you pay a fee to the seller, which is called the premium. When you sell a call option, you get paid the premium. Now, when it comes to selling covered calls, or if you're talking about options within the stock market in general, you're always going to be talking about 100 shares per lot. So it's very important to know that if you want to sell covered calls, you are going to need to own 100 shares of whatever stock or ETF you want to sell the covered call on. So simply put, one option will be 100 shares. Two options will be 200 shares, and so on and so forth. And in this case specifically, we're talking about owning shares of SCHD and selling covered calls on the shares in order to earn a lot more income from doing so. Now, just to go over some of the basics here, this right here is the Robinhood brokerage, but you can sell covered calls on pretty much any brokerage, at least to my knowledge. Now, when we're selling covered calls, we're of course going to want to go to sell, we're going to want to go to call, and then this right here, this drop down is all the different expiration dates that are offered. Now, generally speaking, the further away the expiration date is, the more expensive the call option is going to be, but which also means as the call option seller, you are going to be able to earn much more premium if you do happen to choose an expiration date very far out. Now, this right here is the options chain, and on the left all the way, these are the different strike prices. So for this example in specific, we're going to be using 100 shares of SCHD or one contract, because 100 shares always equals one contract when you're talking options. So SCHD is currently sitting at $73.42 per share. So for this example, we are going to go with a $74 strike price. Now, this once again means that the seller is willing to sell the 100 shares in theory for $74 per share on or before whatever expiration date we choose. And for this example, we are going to choose the expiration date January 17th, 2025, or 486 days away. Now, because you as the seller are agreeing to sell the 100 shares of SCHD on or before the expiration date for $74 per share. Remember, this is even if SCHD goes to $75 per share, $79 per share, $100 per share. You are agreeing to sell SCHD for $74 per share. And of course, you could always choose a higher up strike price, all the way up to, much higher numbers. But remember, the closer that you sell the covered call to the actual share price, the more amount of premium you are going to be able to receive. So for this example in specific, you as the covered call seller would sell one call contract of SCHD at a $74 strike price with the expiration date of January 17th, 2025. And now for doing so, you're probably asking, well, what do I get out of all this? What do I get as the seller for offering up my shares to a buyer for just $74 per share? Keep in mind, SCHD from now till expiration date could go up, it could go down, or it could trade sideways. But by doing so, the buyer is going to be buying the call option for $4.70. But remember, because we're talking options, it's always times 100. So the seller of this call option would receive $470 in premium just for allowing the buyer side the opportunity but not the obligation to basically rent their shares and purchase them on or before expiration date for $74 per share. So now what's pretty crazy is that if we go back to the calculator, remember off of your 100 shares of SCHD, you're going to receive around $260 or so per year. Now, because January 17th, 2025 isn't necessarily just 1 year away, we're just going to go with 1.5 years away. So if we were to take $4.70 or $470 and divide it by 3, it's right around more or less $155. Now, because it's 486 days away, and because we're using the example of 1 year, we're just going to go with $300 or $3 per share. Now, this means that you as the owner of the SCHD shares, as well as you as the call seller, would receive not only the $260 for holding the 100 shares of SCHD for a year, but you would also receive around $300 in premium within that year time frame. Once again, $470 is how much you would receive over 486 days of expiration, but we're just using $300 because we're talking within a 1 year time frame, trying to figure out how much we're going to earn within that 1 year. Now, for doing so, for holding onto your shares of SCHD, you're no longer going to just receive the $260 of dividends, which is still really good, but you're now going to receive $560 of income just for holding on to 100 shares of SCHD. Now, what's pretty crazy about this is that if you were to do the math on that, SCHD now is yielding around a 7 or 8% trailing 12-month dividend yield if you were to add the premium in there also. Not to mention, by selling covered calls, you are also limiting some of your downside risk. Because once again, take the example we went through. $74 strike price with $470 more or less a premium. Because you were paid that premium right away, you can basically take that off the cost basis. So if you bought SCHD for $73.48 per share, let's say for this example, you could then minus $4.70 per share of SCHD, which means your cost basis in theory would be under $69 per share. Now, of course, the risk of selling covered calls is that if SCHD in the meantime, within that given expiration date that you both agreed upon, if SCHD does move up in price quite substantially, you are only going to have a capped amount of gain, which of course is a downside to covered calls. But if SCHD trades sideways or even trades a little bit down within the time frame of the expiration date, you will not only of course receive the dividends from holding on your 100 shares of SCHD, you would have also received your $470 of premium for selling the covered call to the buyer, and also you'd be left with your shares if SCHD stays trading sideways or down below. So for the investor out there that's not necessarily thrilled with the starting yield that SCHD currently offers of right around 3.5, 3.6% as of right now, utilizing covered calls could be a great way to juice up the amount of income that SCHD pays out on a yearly basis. And just for example, the math that we went over in this video, you could easily conservatively see 5, 6, 7, 8% of income paid to you for every 100 shares of SCHD that you own. But when it comes to SCHD, selling covered calls, and this entire strategy, is this something perhaps that you would utilize in your portfolio? Comment yes or no down below. If you enjoyed this type of video and you want to see more videos like this and want to see me go deeper and deeper into some of my really more advanced strategies when it comes to options trading in general, make sure to please comment yes down below and subscribe for more content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.